Yeah, good afternoon, everyone. So, in previous sessions, we were going through the candlesticks and some trends, and we are pretty much close to demand and supply theory in technical charts. So, let me share my screen. And generally, let me know if my screen is visible. Yeah, fine.
Yes, it is visible.
So generally taking webinars or any classes, I do not share my profit and loss statements. But yesterday I had talked with some of my students and some other people also, and there was one misconception which I wanted to just get through that. It should be beneficial. So if I just randomly take this month, and if I see, so you can see I have multiple trading accounts. So this is one of my account where I trade based on my monthly targets, where I teach my students also there. So the capital used here was 2.5 lakh exactly. Let me take you through some calculations. Why I am showing you these numbers is that so that you can have a realistic expectation about investing and trading both. This is very much essential. So my target for this month was for July was that I will trade only on 2.5 lakh capital. That's it. I am having almost 8 to 10 lakh in other accounts, but I wanted to trade on that. And my expectation was around 10 to 15% of my capital. So for 2.5 lakh, what should be 10 to 15%? It would be around say 25k to maximum 40k profit I'm talking about. So anywhere between 10 to 15% or at most 20% if you are expecting on your capital on a monthly basis, be it trader or an investor, that is more than enough. That is very, very good, and that is more than enough. So now if you see, I have already made 1.8, deducting the charges, it is 1.7 on 2.5. So it is almost more than 60-70% gains what I made on my capital. Now, this is not the point. What the number is, this decimal can be here also, and this decimal can be here also. This number is not the point. The point is my percentage. And if you see here, green means the days that I have closed in profit, and red means the days I have closed in loss. If you see how many days are here, 4 here, 8, and 5 here, 13. So 13 days I have traded, out of which I have given losses in 1, 2, 3, 4 days. What is my accuracy here? Almost you can say 60% accuracy, 60 to 70% accuracy. That's it. So my first point that I want to make is that you can never be 100% right in investing or trading, applicable for both. You can never be 100% right. Secondly, you should decide everything based on percentage, your percentage of risk, your percentage of returns. So say on a 10 rupees investment, you are making 10 rupees, you are actually gaining 100%. That is very, very excellent. You cannot invest 10 rupees and say I want 100 rupees. That is a very illogical expectation. You might get it, like in this month I got more than 60 to 70% return, but that is not a very joyful thing. It is not a stable return. It might happen that my trades went very, very well. Now comes one more part. Losses, be an investment, be it mutual fund. Even if you are investing in mutual funds, your portfolio will not always be in green. It will come down, it will go up. Your NAV, net asset value, will go up and down, but the calculation always remains the same. What is the calculation? I'll show you what I want to say. If you see here, these are all my trades that I took. We are interested here, they realized profit. So if I take top 5 or top 10 trades, you can see what is the range of the profits. You can say 30 to 50k. I can say that 30 to 50k is my profit range for my best trades, most of the trades. There are more. If I scroll down, there are more, but 30 to 50k is main. Now if I go to my losses, my major losses, what you see here, my major losses 19k, 11k, 744. So you can say my losses range is, if I take an average, you can say 5 to 15k. If I take an average of these, I can say 5 to 15k. or if you want to take losses more, say 10 to 15K. This is my loss range. So what did we see here? Observe here. Profit range is 30 to 50K and my loss range is 15 to 20K. You see, my profits are always double the loss, almost, which means even if I have only 60% accuracy, the trades in which I am giving losses, I give between 15 to 20 only, and the trades in which I get profit, I get between 30 to 50. So overall, I am still in profit. So the point again that I want to make is stock market, be it investing or trading, be it mutual fund, passive income, it is totally a game of probability. This thing, you need to get it in your head. It is probability. There is no 100% accuracy. So probability should be always highest when you take the trade. And for that only we learn about fundamentals and technicals, so that we can say that, okay, based on these of my checklist, I can say this trade or investing has the highest probability, so I should go for this. After that also, there is no guarantee that you will make a profit, but the losses should be always be in your hand. You should always know what should be the range of my losses. So if I go one by one, you see here, on this day, the gross JLX profit is 40,000. Next day, it is 15,000. Next day, losses is 14,000, 32,000, 17,000, 32, 31, 5,000, 10,000. So when you see every day, you can simply understand that I am not gambling here. There is no gambling here. Everything is properly calculated. Everything has a logical explanation here. And this is how we plan out that. Simply, I'll just close this and I'll come down to here. Say you are having 60% accuracy in investing. Forget about trading. I'm talking about investing only. 60% accuracy. You take 10 trades. That means you get 6 trades in your favor. How will you make profit? Every trade you take, there is a risk to reward ratio that everyone talks about, which means that if after entering a trade, if I risk 1 rupees, my reward should be at least 2 rupees. This is 1, this is 2. Now if you calculate here with 60% accuracy, 6 trades are in my favor. That means 6 into 2, I am earning 12 rupees and I am losing 4 trades. So 4 into 1, 4 rupees is going down. So from 12, 4 rupees has gone down. Then also I am taking home 8 rupees. This is the very simple and basic calculation how we should invest or even trade in stock market. So again, coming back, suppose we are making a portfolio and I want to include 10 stocks in my portfolio. Good stocks, very good stocks, renowned stocks, Reliance, Infosys, HDFC, 10 stocks. And I want to invest equal amount in all these 10 stocks. Say 10K each. Totally, I'm investing 1 lakh. 10K each in these 10 stocks. You want to create a good portfolio. So when you are doing this, you need to be pretty much sure that for each and every stock, what is the point of your entry? Where are you entering? Say for Reliance, you are entering at 2,500 price. Say for Infosys, you are entering at 1,500 stock price. So the moment you take an entry for investing also, your risk should be decided that, okay, once Reliance falls below 2,400, I am going to exit from Reliance. I will give 100 rupees loss and I will simply exit from Reliance. Making a portfolio and investing does not mean that even if you are in red, you should stay invested for 5 years, 6 years and hope that yes, once price will go up and I will be in profit and then I will exit. No, that is the wrong approach. You will just lose your time. What is smart investing? Smart investing is that we should gain good percentage return in the least amount of time. So when we see marketing memes and what is that called, photos in Instagram and some or others. If you had invested 15 years in Wipro, your capital would have grown 10x. In 2000, if you would have invested, now in 2023, you would be crorepati, you would have crores of money. These things look very good in paper, but this is not realistic, and this is not practically feasible. Why is that? I will tell you. Already 20 years of your life is gone. First of all, we do not want to invest so much time to gain that much profit. We should be smart. Secondly, say there is a stock whose price is 50 rupees. You have bought at 50 rupees. Now some people say there is a penny stock of 10 rupees. It has gone to 1000. I should have invested there. I would have made so many money. Once you think when the price of stock would go from 10 to 100, your profit would be already 10x. It would be showing 10x in your portfolio, and your heartbeat will be thumping. Let me get out. I'm already getting 100 rupees from 10. What if it falls? It is enough for me. So practically, being a human being, you need a heart of a diamond to hold your profit from 10 rupees to 10,000 rupees. Nobody can do that. On paper, it looks very good. When it has already happened, it looks very good. The moment you get from 10 to 20, your screen will show 100% returns. That would be enough reason for you to exit. And then from 20, it will go to 50 and you will say, oh no, I exited, I should have kept. But it does not work like that. So we should be practically logical about our investing and trading things also. That is why we are going through these webinars slow and steady, so that we understand what is the entry point of any stock for good investing or good trading, and what is the exit point. What is the risk? What should be my reward? How should we calculate it? Like now Nifty is 19,000 plus. Is it advisable to go for mutual fund? No, it is not advisable. Always do mutual funds, invest in mutual funds when there is a dip in market at least 1,000 points. Say from 19,000, Nifty again comes to 18,500. At that point, invest in your mutual funds. So all the brokers who say do SIP, I never recommend SIP. I have calculated everything over SIP. I will never recommend an SIP, because what happens in SIP, in the beginning of the month, whatever might be the price of Nifty, whatever might be the point of the index, your amount will be automatically deducted. So say this month on August, Nifty is at 20,000. You do SIP for 5,000. You get 5,000 worth of some units of Nifty, 5,000 worth. In September, say Nifty goes down to 19,000. This 5,000 will again go down to 4,000. So SIP, but my point is what? On September also your 5,000 will be deducted from your account, because every month your SIP is active. 5,000, 5,000, 5,000, it will be deducted. Now after deduction, if Nifty keeps on going upside, then we can say I am in profit. So I never recommend an SIP. I always recommend, even if you want to invest in mutual fund, do it manually. Whenever there is a drop in Nifty, 500 points, 1,000 points, invest in mutual funds. Again, there is a drop in 1,000 points, again invest in mutual, because market is never going to go to zero. Our India's whole economy is 90% dependent on stock market. If there are no investors, there will be no good companies. There will be no Nifty 50. So until the last day of earth, stock market is not going anywhere. Index might correct from 19,000 to 9,000. That much it can go down, like in COVID, but it will never go to zero. So this was one of my points. Now coming back to from where we had left.
Akash, if you let me, I'll just like to add a few points to clarify.
Sure.
The thing Akash explained is, again, not to stop SIP after we finish this webinar. Okay. The thing is, once we learn, we should not be doing SIPs.
Yeah, correct.
Yeah, it's not like SIPs are not recommended. If we stop SIP and don't invest or do anything, then again it is bad. Like we have to keep continuing. SIPs are, Akash's intention is to say that SIPs are people who are not aware of these concepts, whatever we are learning
Absolutely.
in webinars.
Absolutely correct.
So if you are finishing these webinars, if you are learning something and investing smartly, then SIP is not required. So we have to be eligible for that first to stop our SIPs and do it. Okay. As a disclaimer, I
Exactly
also
correct.
have SIPs. I am also learning new. So I will stop once I think I learned.
Exactly
Okay.
correct. So once
And
you are,
yeah,
yeah.
yeah.
As
So, and the purpose actually. So we have to always question our one thing actually, why. It is called start with why. There is a book also. Sometime we will discuss about that as well. So everybody has to read that book or read or listen to that book actually. So it is like start with why. So whatever we are doing, whatever we are thinking, whatever the decisions we want to take, we have to start with why. So if I put that question to these webinars, like why are we conducting these webinars? You can say other business angles, profit angles, everything, but the real intention is to help retail investors build conviction in stock market and create wealth. That is the mission we are working on.
correct.
You know, so as Akash explained, once the 10 rupees becomes 20 rupees or 30 rupees, what keeps one to stay in the stock is conviction. For example, 10 rupees has become 100 rupees for you. Fear takes over. That's what Akash mentioned. Fear takes over. Like, I already got 10 times. What if I lose this money? Let me book the profit. So that fear is something, and greed is something. Greed is like, okay, it has already gone up 10 times. Let me wait for 100 times. That time it may fall. So
Correct.
we have to get over fear and greed. How we can get over fear and greed is building conviction, whether it is trading or investing or SIPs, whatever it is, building conviction. If it is investing, so if you are fundamentally tracking the company, if it has gone 10 times, then you would actually know whether it has potential to reach 20 times, 30 times, 100 times or not. If it has, you will again average up. You will add more stocks. Only if you know that it is going to go up with conviction.
Correct.
So building conviction is important in anything actually. So our attempt this is to help you build conviction with your knowledge, practice, and discussions. Okay. So hopefully we are able to bring value. And thank you, Akash, for letting me allow. If I'm wrong in any manner, please.
No, no, absolutely correct. Actually, I was also about to come to this point only. So it's good that you already explained. Yeah. So now coming back to from where we had left yesterday, we were talking about trends. So we were talking about downtrends, which looks like this, and we were talking about uptrends, which look like this, and sideways trends. So why these trends are important and why we are emphasizing so much on this trend is that these trends help you to generate wealth. Trading is short term, but if you are able to capture big trends, you generate a good amount of wealth in trends. So if you understand how these trends are forming, and if you invest even for 3 months to 1 year, it is enough to generate almost 40 to 50% of your wealth. Yes, I'm talking about 40 to 50% of your capital, even if you are able to capture one good trend. So that is why we are emphasizing more on it. So yeah, today that I thought that I would discuss is that investors and traders psychology, which helps in forming trends. So few things I would like to again repeat once 1 minute. There is a word called position. I had discussed it before also. So what is a position in market? Position means you have entered into the market. So how can you enter in the market? Either you can buy a stock. Suppose you have bought ITC shares. So how would you say that to someone? You will not say that I have bought ITC shares. You will say I have made a position in ITC. That would self explain that, yeah, I have bought ITC. Now positions are of two types. We know there is a long position and there is a short position. We can enter into the market in two ways. What is a long position? Long position is when we buy something at a lower price and we profit when the price rises. This is a long position, which is called buying. We buy something at 100 When price goes up, we get profit. And what is a short position? It is just the opposite of long position. We sell something at a price, whatever is the price, and when the price goes down, then we make profit. This is called short position. So in investing, we make only long positions. We buy stocks at cheap price and we expect it to go up. But in trading, we can trade both ways. We can trade upside also, we can trade for downside also. So say Reliance is just 2600, you make a short position here. You sell at first. You sell at first. And when the price goes to 2500, you benefit from this fall. This 100 rupees is your profit when it falls. That is short. So we cannot say that only buying governs the movement of stock, Nifty or mutual fund. This both long and short positions do govern the movement of the price. So we should know about these both of these. Now, suppose you have bought something at 100, B for buying. Okay. When will you incur a loss? When the price goes below 100. Similarly, when you make a short position, suppose you sell at 100 at first, you will make loss when price will go up. Just the reverse of buying. And you will make profit when the price will go down. So shorting can be done on intraday basis. Intraday shorting is allowed. Apart from that, you need to do futures and options for shorting, which we are not discussing right now. So people do this, but the point here I am trying to make is that when we study about the trends, we will try to understand these things. Now, step by step, say I am an investor. I bought a stock at 150. I am making a long position. Long means I am buying at first. Now, suppose you have entered into a position. What will you do to exit the position? You will sell. You have bought something. Obviously, to close that position, that means to exit from that investing or trade, you need to sell that. So for selling, again, there is a word. It is called square off. We say I have squared off my position, which means I have exited my position. So if we buy first, we need to sell to exit. Just the opposite for shorting. If we sell first, we need to buy back to exit. Just the opposite mechanism of long position. Fine. Now, suppose we buy at 150. Our target is 170. This is our target. We have analyzed and we have made a decision. We will exit at 170. And my risk is 160. What is the meaning of 160 risk? It means that if this stock falls by 10 rupees, I will exit here. I will not wait for it to go much further down. I will give 10 rupees loss. I will give this loss and I will exit. This is called stop loss. Similarly, for selling, suppose I am shorting. Now, this is the point where you should be a bit attentive. Suppose I am shorting at 120. How will I make profit when the price will fall? Say my target is 150. I have targeted 5 points fall. When will I get a loss? When price goes above 120. Say price goes at 130, I will get a loss of 10 rupees. So this is my risk now. So what do we understand? In buying, our risk is below our buying price. And in shorting, our risk is above our selling price. Fine. Any doubt in that? Just type in the chat yes or no. Everyone has understood or not. Then I will move to the main topic. Guys, just tell me if it is okay. Any doubt here? In long position, short position? Yeah, fine. There is one question about tax. Okay, we will come to that in the end of the session. Fine. Now we will take a scenario. This is an uptrend. You know, uptrend goes like this. This is 100 rupees. This is say 110. This is 105. So what is the cause of formation of this whole structure? Why this uptrend is like this, higher highs and lower lows? We will take an example. Say here are three people, A, B, C, D. They can be investors also, traders also. All four are individuals. Also, we have E and F. These two are institutions, big hedge funds. Among these, who is trying to go long, who is trying to go short? What is the meaning of trying to go long? Who is trying to buy, keeping a view that price will rise, and who is trying to sell, keeping a view that price will fall? We do not know. Anyone can be anything. Now let's think at 100 rupees, A and B wanted to buy at 100 rupees. Along with A and B, there were X number of more investors and traders. X can be anything, 1 lakh, 2 lakh, 3 lakh. Along with A and B, they were also in a mood to buy. Their view was that stock will go up. So due to this intention of buying, a demand was created. They demanded, what did they demand? They demanded stocks. I want that share. A said, I want to buy. B said, I want to buy. There were X number of investors. They said, we also want to buy. Due to which demand increased. So they bought at 100. And due to the increase in demand, we know that when demand increases, price also increases. Price increased to 110. Now what happened? C and D, they were unable to buy at 100 due to some reason. It might be any reason. They might not have that fund. They were not interested at that time. They were thinking that price will go more down, or they were invested somewhere else. There can be n number of reasons. C and D could not buy at 100. Now when the price went up to 110, their view has changed. Now C and D, they are looking for an opportunity to buy. So what they are thinking, price has gone how much up? 10% up, from 100 to 110% up. And 10% movement of a stock is a very significant movement. You cannot say 10% is very less. In an FD, you get 7.5% yearly, 7%. And if a stock is rising 10% in 1 month, it is a very big deal. Now CND is saying that let the price come down a bit, then we will try to buy at a cheaper price. At 110, I don't want to buy. They are waiting for their moment to buy. Now from these guys, A, B, and XYZ investors, A is thinking that, okay, fine, I have got 10%, I am satisfied. I don't want more. I will book my profits. Then how will he book his profits? Since he had bought at 100, he has to sell his shares to book his profit. So now at 110, who will be the sellers? A will be seller. Why A will be seller? Because he is wanting to sell his shares to book his profit. He is satisfied. The moment A sells his shares, there can be again X number of people who think like A, who are satisfied with 10%. If you ask me, if I am getting 10% in 1 month, I am satisfied. I will exit. There can be 100 more people who think alike like me. There are 10 crore people who trade in India. So these are the sellers who bought at 110. So now the moment these sellers want to sell, there is a supply. Due to the supply, price will come down. Now when the price is trying to come down from here, there is no demand at 110. Mark my word, there is no demand at 110 because people like C and D, they want a bit cheaper. Let the price come down. They're waiting. There is demand, but they want a bit more less price. Price is coming down slow and steady due to profit booking. The shorters will try to grab this opportunity. Who are the shorters? Who make a short position. They sell at first and make profit when price goes down. So shorter will think that, okay, from 110 price is coming down, let us short at 110 and we will make profit when the price goes down. So say there is a shorter Z, he shorts here, and there are again n number of people who thinks alike, who are shorting at Z. Price is coming down. When the price is coming down, these shorter Z, they are making profit because they make profit when the price goes down. Fine. Now one more thing, when they are shorting, they are also having a risk. What is the risk for Z? The risk is when the price goes above 110, Z is going to incur a loss because Z has shorted at 110. He will make profit when the price goes down. The moment price goes above 110, 111, 112, Z will start to make a loss. So Z has decided that if the price goes above 110, say 115, I will exit. So there are n number of people who think alike like Z, who have shorted. Now say price is coming, price came to 105. The moment it came to 105, C and D were waiting for the opportunity. They will say, okay, price has come down now. Now it is good time, we can buy, it is fine. They will enter at 105. C and D will buy at 105. There will be again n number of people who think like C and D, who were waiting for this opportunity. The moment they buy at 105, again demand goes up. And when the demand goes up, again price starts to go up from 105. Till 110, everything is okay for Z. The moment demand pushes the price above 110, Z starts to panic because he is in loss. Now what will Z do? Now Z will exit. So when you sell at first, how would you exit? You have to buy to exit, just the reverse. So now there is a demand from C and D, which is pushing the price up. Also, due to Z exiting, Z has to buy, which is increasing the demand double. C and D is demanding, even Z is also buying to exit, which is pushing the price more further than 110. And price now goes to 120. Again, there will be some people along with Z who exited at 105. They said, okay, 5 rupees I have shorted, 5 rupees I have shorted, I am fine, I will exit. So they will also buy at 105 to exit. So now price has gone to 120. Now when price has gone to 120, from here you remember from 100 rupees, A had exited. B was still there because B wanted more profit. Now B is sitting in how much profit? 20% profit. From 100 it has gone to 20. Now B is satisfied. B says, okay, my appetite is full. Now I will book my profits. So at 120, who are in profits? B is in 20% profit, and C and D, who had entered in 105, they are also in profit, 15 rupees. Again from C and D, it might happen that some of from C and D will think that, okay, I have got good profits, I will exit. Again he will try to exit. Again shorters will try to come, and same story will repeat what happened here. And since this same story keeps repeating, price keeps pushing itself up. So now I will come to that point when I said A, B, and n number of investor. Again here I said Z plus n number of shorters. Again, here I said C and D plus n number of investors. Why I kept it as n? Because the demand of this n will decide what is more powerful. Say here there are, this n is 1 lakh. What does this mean? It means 1 lakh person are shorting, pushing the price down. And say here n is 2 lakh, which means demand is 2 lakh. So you can see demand is more than supply. That is why this price went up. The moment it happens something like this, say suppliers are 1 lakh and here C and D plus demand is only 50,000. What we see, demand is less than supply, then price will come down. It will not break this point. So the forces of demand and supply pushes the price up and down. So this is the mechanism which leads to this trend formation. Every time a highest point of trend gets broken, that is due to high demand and shorters are less. They exit when they hit their stop loss, and that keeps happening till a point. So now if I go to a chart to elaborate this thing, to get a real time say understanding, let me take any chart, whatever chart, say IOC, Indian Oil Corporation. If I go into this, say weekly time frame, to get a better insight. If I try to draw that uptrend here, you see, so this is an uptrend. This is one of my lows. This is one of my lows. This is one of my lows. All the lows are respected and all the highs are getting broken every time. So say here they were A and B and n number of investors who bought. Till this much, they were in good profit. Then say A booked its profit, so he exited, price came down. There were few shorters here, that Z we were talking about. Shorters made profit till this much. Again, C and D came here and bought here. When price was going up, this Z exited at this point because he was incurring loss. Or he might have booked his profit here also. Both can happen. Either Z would have booked his profit here, he would have bought, then also demand increase, or he would have exited here giving loss, then also he will buy because he had to exit. Price went up from here. C and D made good profits here. A exited here itself. B exited at this point, due to which again price came down a bit. Again say here E and F entered. Price went till this much. All the shorters here, they exited here because they were in loss. Price again went up. And this same structure will keep on going. It will keep on going till the demand is high. The moment demand goes down, this structure will get broken. So we know, what have we learned? We know very well that the uptrend should not get broken anytime if it has to go up. So what do we say? Suppose if I cut this from here, suppose this is the real scenario as of now. We do not know what has happened next. Say this is the next candle which is forming. This is my next candle forming. This. So what can we infer from here? We can infer is that if we want an uptrend, what is my criteria? My criteria is it has gone up from here. This should not be broken. If it has to go up from here itself, it will reverse. The structure should not be broken. This is how we invest or we trade. So the moment you see this, what you will say that, okay, the structure is intact. This structure is intact. Now from here, if it has to go up, it will never come below this. And the logic we already know. There has to be a good demand here, this area, and shorters will exit, giving their losses, they will buy, and there will be more demand. So we can simply buy here and keep this as our stop loss. We do not need to invest in IOCL at 78 rupees and keep it for 10 years. Why keep it for 10 years? Yeah, we do not need that. We simply know that this is the structure. We will buy at 78, and the moment it goes below this, we will simply exit. And till the point it is above this, we will be in uptrend. We will hold it. So after this, what is happening? Price is shifting upside. Again, see, again the same thing is happening. After this, it is again coming down. So we know that this should not be broken if this uptrend has to continue. It might come below a little bit more. It might spend here so many candles and then go up. But this should not be broken at any condition, this area. So we can again enter here and keep this as a loss. And then we can again wait for the market to decide what it wants. And then when see, so this is how the uptrend forms. And similarly, the same story is for a downtrend also. For the downtrend, the supply is more than the demand. If we check a downtrend in IOCL only, if we want to find a downtrend, we can find here only, because it's part of, yeah, you see here. If we look into this downtrend here, you see there is a fall, a bit up, again there is a fall, again a bit up. You see, this was the point. It tried to break it, but it could not continue. Again it came down, something like this. So just the reverse of whatever is in the uptrend, it is this same logic. So you need to understand that, say you want to invest in a stock for 1 year, 2 year, 3 year, or even in a mutual fund or something like that. Say I want to make an mutual fund investment also. I want to track Nifty. What is happening in Nifty? If you see in Nifty, I will go to, this is weekly chart. Weekly means every candle is 1 week. Every candle is of 1 week duration. So if I draw a trend here, something like this, it is going like this. It is in a clear uptrend. So suppose someone says, is it a good time to invest in Nifty? What will your logic say? Your logic say, it is in an uptrend, I accept, but you can still wait. Why you can wait? Because we know that this kind of a structure is forming. We can expect few red candles here, something like this. And then we know this should not get broken. The moment we see a green candle like this, we know that this structure is again trying to form like this. So we should wait for a bit to see what the market wants to do. And then you can again invest in Nifty. No problem in that. I have shortlisted few trades for investing or short-term trading. So you should trade based on your risk, because I know when to enter and exit. It should not be that you should follow me blindly. I am discussing a pattern with you. You see here, this is Marico. Marico is a very strong company in FMCG sectors, Marico Limited. What happened here? There was a very good uptrend, very nice uptrend, and then it is a sideways market. After this sideways, it can either go down or it can either go up. Only two options. After sideways, it can go up or go down. If you see here, what I see at this point, after this sideways market, I can see this point from where it fell. It tried to go up, again came down, again went up from here. So this is not broken. In an uptrend, we know the lows should not be broken. This is not broken. And if you see closely here, if I try to draw this pattern, I can see this. So what should be my visualization? How should I visualize that in my mind? Next week, So this is a monthly candle. Next month, a candle should be something like this. Then this pattern will be complete, and then I can say it can move upside like this. So as of now, this low point is very important to me. As of now, this is very important to me. Say this is July and it closes here itself, and in the next month it just starts to go up like this. I will simply enter here and I will keep this as my risk. Why I will keep this? Because I know that I have seen n number of times that this is the uptrend structure and it has to go up. It will go simply like this. Now say if there is a red candle like this, now what will be my view? My view will be still intact, but my risk point will change. Now my risk point will be this, because I know it can happen that from here it can make a green candle like this. So what is not in our control? We cannot control the formation of candle. This is not in our hands. It can happen, it can make a green candle from here itself. Then also this is fine. It can happen for another month, it can come down, and in the next month it can go from here. This is also fine. So if we trade here, we know this is our risk, logical risk, because we want from here itself to go. And if we want to keep this as a risk, we can still wait for a red candle so that we can get a cheaper price, and then we can expect this. This is how we visualize in investing also. Same thing. If you want to go to fundamentals, say you are not a technical guy, you want to be fundamentally sound, how will you see that? Mariko, screener. I will take you through both the aspects. It is not that fundamental is bad, but you need to know how to analyze that. So this is screener.in. Here you can find all the fundamentals of each and every stock. What is its current value, what is its sales and expenditure, everything. So currently March, current results are not out. This quarter results are not out. January, March, April, May, June. June is due, I think July. Next week you can get results. This is the previous one. So what we can see from here is that if you simply see this net profit as of now, 377, 307, 333, 305. So profit is pretty much stable. Everything is stable as of now. Not much of a difference I can see here. Profit before tax is also same. Anything which is alarming is that, yes, see what is alarming. You can see operational profit. What is operational profit? Simply sales minus expenses, nothing else. That is operational profit. If you minus this, you will get this. You see here, December quarter's profit was good. This March was pretty much less. So what do you see here? Operational profit went down. How much it went down? Almost 56 and 7, 63 crore. It went down. If you convert it into percentage, 63 by 456, it is almost say 12%. So 12% profit came down. Why did it came down? How do you analyze fundamentally? Why did it came down? You see the sales and then you see the expenses. You see both and then compare. You see sales is a bit less, expenses is also a bit less. Ultimately, due to this sales coming down more, how much did sales come down? Sale went down by 450 CR and expenses went down by 150 and 240, say 350, 390 CR. So sales was a bit less. That is why operational profit came down. But my concern is this other income. What do you mean by other income? It is not specified. What is this other income? You see, it was 40 there and now 68. So 28 crores of more other income, which is not specified, which is ambiguous. And this other income is varying, sometimes -6 crores, sometimes 83 crores. They are not disclosing what is this other income. So we can say that this is a shady income. We do not know what is this. Profit before tax is also a bit less. So if someone says that, okay, fine, how should we invest in Marico based on fundamental analysis? What do we want here? We should wait for the results. When is the result? Result is this July, last week only, most probably. In that result, you need to see, what do you need to see? What is this other income? You need to see what is the operating profit, and then you need to see what is the EPS, earning per share. Earning per share, if it is say more than 2.5, 2.3, say it is 2.7, it is fine. Then you can invest in Marico. Then also you need to have a stop loss. Fundamental does not mean you would not have a stop loss. So say, let me see when is the date for this event. We can get that date from here also. See here. India's Dabur expect rise in quarter sales. Marico revenue falls. This is July 6th. This is not now. Upcoming, it will come. So next week result is due. Suppose the results are very good. Suppose Marico's results are very good. So we know it's a good time for investing based on fundamentals. Then also if we enter here, we will keep our stop loss here only, or here only, this point only. Because ultimately it's a game of numbers, even in the fundamentals also. So in some webinar, we will discuss on fundamentals also. After this technical series, we'll take up that also. As of now, we'll stick to this. So today's point of discussion was why this uptrend is forming. What is the logic behind this? How the sellers and the buyers are thinking? What are their thinking process? And how we can capture these trends. We have still not discussed anything about entry. We have still not discussed how we will enter, how we will exit, because that is to come. We need to gain some more ground knowledge. So slowly and steadily we will go. In the next webinar, we will now get deeper into demand and supply. We will start to see the structures of demand and supply. What are the structures of demand and supply based on charts? How you identify those things and how you can invest and trade also. We'll come to that. As of now, we are done. So we'll take some questions. Whatever you can doubt, you are having your doubts, and if you want me to revise or recap anything, I will surely do. Please take 5 minutes, and whatever you want, you can ask. I'll take up this question at the end of the session. I would like to ask you, on a day, how to decide on the stocks to trade? Is tax reducing? Yeah. See, on a day, how you decide to trade on the stocks is, firstly, you need to see the sentiment of the overall market. So you need to see Nifty 50. What does Nifty 50 say? Secondly, you need to see the sector. Sector means pharma sector, IT sector, auto sector, banking sector. Which sector is looking good? Thirdly, then you need to screen the stocks one night before, which means that if tomorrow I am going to trade on a Monday, I cannot simply open any random chart and start trading. I have to shortlist 3 to 4 stocks on the previous night, that is today itself at night, and make a plan that, okay, tomorrow I expect Nifty to be bullish and XYZ sector to be bullish. And based on that, these 3-4 stocks are there, which I am planning to trade. This is how we plan. We do not impromptu decide any stock. That in the morning 10 a.m. I opened my terminal, and whatever stock I saw a green candle, I simply bought. If you are doing this, then that is not good. You should not do that. Everything should be planned. Preparation should be prior. Is tax reduced immediately for trading profits, or profit minus losses throughout the year will be considered for tax? Actually, taxation is not done like this. You are right, profit minus losses only. But there are 3 different rules for taxation. One is for capital gains. One is for intraday. I'm talking about calculation, how tax is calculated. And one is for future and options. So all 3 have different mechanisms. In capital gains, what happens? If you are keeping a stock for more than 1 year, it is different kind of calculation. If you're keeping it less than 1 year, different calculation. In intraday, it is called speculative trading. Intraday. In intraday and future and option, what they do is that whatever is your turnover, that is considered for your taxations, right? For example, how would I explain in simple language? Say you bought 100 shares for 50 rupees and you sold those 100 shares for 80 rupees. So how much you paid for buying? 5,000. And how much you got back after selling? You got 8,000. So when you subtract this, you get 3,000 profit, right? So for taxation purpose, if this is on normal equity, you will be taxed flat 15% on 3,000. But if it is on future and option, the calculation is something different. So from your terminal, you can get all your trades, which was your intraday, which was your FNO, and your terminal will automatically calculate. In Zerodha, at least there is automatic calculation. They automatically calculate and tell you that what would be your tax. Anything more questions or doubts regarding our discussions or anything else?
Yeah, I have two questions, Arush.
Yes, please.
Yeah, just now you have told that one day before we have to assume that Nifty will be on bullish and the sector should be on the bullish and then our shares on the bullish. So we have to
Mm-hmm.
do that. So will that be possible? Like Nifty might go down and our sector might go down, but our shares will go up, or Nifty might go down, but our sector is goes up. Then it's a good indication, or how that probably we have to take.
Yes, that is totally possible. Totally possible. So what we do is that we try to pick only those stocks which are aligned together. Like Nifty also same view, sector also same view, stock also same view. So if you want to take an example, suppose if I go to Nifty and I simply do an analysis, what can happen tomorrow is that this is my daily candle in Nifty. I can see here. So in daily candle, I can see a red. So tomorrow, only three things can happen. Why only tomorrow? Every day, only three things can happen. Either they can be a red candle like this, either you can find a small halt candle like this, or you can find again a green candle like this. Only there are these three possibilities. It can happen that tomorrow there can be a small candle and then Nifty can go up. Then this structure will be complete.
Okay.
Or it can happen then there can be a halt tomorrow and then it can happen like this. There can be a structure like this. Now, how do we see? When we break into time frames, we go into smaller time frames. And in the smaller time frame, this is 15 minutes in the morning. So in the morning, if I see that Nifty opens somewhere higher, first 15 minutes and makes a green candle. You see, we always talk about swings and stop losses. Swings means these swings, and stop losses means wherever I enter, what would be the point where I will exit. So if I am a trader and if I want to trade at Nifty tomorrow, suppose Nifty opens here and makes a green candle like this. The next candle is something like this, and the next candle is something like this. As a trader, what would I speculate? I will speculate is that, okay, I can see something like this. If it has to go up, from here only it will go. I will buy here and I will keep my stop loss here. Or suppose Nifty makes a red candle like this tomorrow. What would I do? I will short here and I will keep my stop loss here because I know this structure is forming. If it has to go down from here, it will automatically go down. It should not again go up above this. So the points where the traders find very easy for the movement, they try to go to that side. So if tomorrow, if I see a red candle like this, first 15 minutes, what would be more easy, selling or buying? Selling will be more easy because I know this is forming. If I short here, it should go from here itself. So based on that, we try to understand that, okay, tomorrow, what can I expect? What should I expect tomorrow? So if I expect tomorrow is that my view is tomorrow is bullish. Suppose my view is bullish. I will trade only if Nifty is bullish. If Nifty is tomorrow bearish in the morning, I will not trade. Simple as that. So for my criteria to be bullish tomorrow in Nifty, I want at least first 5 to 10 minutes a good green candle, so that I can now speculate that, okay, fine. From here, there is a green candle. If it has to go up, from here only it will go. So my first criteria is done. My preparation is done, that I will trade in bullish Nifty and I want something like this. Now I want to see some sector. Which sector should I pick? Suppose I go to Nifty Bank, the most popular sector. In Nifty Bank, I see something, this kind of a structure. This is in hourly. Again, my view is bullish. I do not want that Nifty go up and other sector go down. I want in the same direction. So in Nifty Bank, I see it is something like this. It is holding. So what should my criteria? So that Nifty goes up, bank goes up tomorrow, it should open a bit higher, and then in the morning itself it will start to make a green like this. Then I will say, okay, from here it will move.
Yeah, in the morning, this green candle differs for like 15 minutes, 1 hour, or 1 week or 1 day candle, right? So,
Yes,
so
in the morning, if you see the first 5-minute candles, 3 candles only,
okay,
yeah, that would be enough to make your view that, okay, what is going to happen today.
okay.
And
So
that
that's from 9 o'clock or 9:15 or 9:30.
9:50. First of all, the opening is important. So 9:08, at 9:08 you will get to know how much point it is opening, gap up or gap down. 9:08
Okay,
after the pre-market. So once you know that tomorrow Nifty Bank is opening, say minus 100 points at 9:08, you get to know, you can see that at 9:15 it will open minus 100 point. It will show. That means, let me go to 15 minutes chart. This is my Nifty Bank where it closed. So what does minus 100 point means? Somewhere here it is opening. So now you see, if it opens here in the morning, give it 5 to 10 minutes. The moment you see something like this, that means it tried to go up and now it is coming down. What you can say, it is trying to form something like this. So from here, going below is much easier option, downtrend. So what shorters will do, traders will do, they will try to short here and they will keep this as a stop loss. And then they will try to push the price down. Now say if Nifty Bank is opening 200 points plus. So 200 points plus means now it will open somewhere here. So first 5 to 10 minutes, if there is a green candle, something like this, you can say, okay, now this area is looking safe. From here, it has to do pretty much of a hard work to come down. It will simply come a bit down and then from here only it will go up. So which side is looking more easy to go? That you have to visualize, and with practice that will come.
okay,
So now when I have prepared that Nifty, my view is bullish, Bank Nifty, my view is bullish. So I see Nifty is opening plus 40 points upside, Bank Nifty is opening say plus 100 points upside. Now I have to see my banking stocks, which stocks I should shortlist. Suppose I shortlist ICICI Bank. So in ICICI Bank, let me just remove this. I don't need this. I do not use these earnings, these all. I do not use this because these distract me from trading. Yeah, now in 15 minutes, what do you see in ICICI Bank? You see a picture perfect bullish condition. You see there was a rise, there was a sideways momentum, and now it is ready from here. If it has to move up, it will simply move up like this. So if Nifty is okay, greenish, first 15 minutes, if Bank Nifty is greenish, and if ICICI Bank say opens here somewhere, the moment it opens here, I will simply buy here and I will keep my stop loss as here, because I know if Nifty has to go up, From there itself it will go. Along with it, it will take Bank Nifty also, and along with it, ICICI Bank will also float above. This is how we plan all the trades. If you see Bandhan Bank, you see something like this in 15 minutes. In daily, what do you see? And now if I open here Bank Nifty, I'm just giving you an insight. You see, for so many days, Bank Nifty was in uptrend, right? You see Bandhan Bank, it was doing just the opposite. It was falling. So that is why we need to align everything together. The mother index Nifty, then its sector, then its stock, and then we shortlist the trades. And when we do our proper technicals, this whatever we are learning, when we do everything, we get confidence, and then we can easily trade or do investing also.
Okay. My second question is on day one, first session. So you have mentioned that so there will be some huge investors. They might be putting some X number of lots for some price. So they'll keep on waiting. Even it takes some months, 3 months or 6 months or 9 months also. They'll wait to
Yes.
that price and they'll buy there for longer. So that you showed on that day, but after that I was unable to get how to see that. So this huge investors, what price they are keeping the buy option.
Yeah, we will discuss that also. I will show you an example. When we start talking to candles, we will come into candles also, what candles are saying. Then we will automatically get to know that which candle says that okay, big investors are here, and which candle says that okay, no one is interested. When you see here, you just see this big green candle. If you compare this green candle with all these candles, it is way much bigger. And this, what is this green candle? It simply says that demand is very, very high. So there was a very big demand here. Price shot up. So it might have happened that the big investor who wanted to buy crores of share here, he could not grab all the shares. Say he wanted to buy 2 crores of shares at this price. I will mark the point. Say this price, he wanted to buy 2 crore shares, that huge investor. But due to high demand, price went up and he could buy only say 1 crore. So he waited. This is in 2021 end. He waited for so many days. And now at the same point, you see this big green candle, which is still forming. This is monthly candle, which is still forming. And you compare this candle with this is again trying to form a big candle. So the orders which he could not buy, now he is buying after waiting so much. If you see in daily candles, Z Limited, these are the same candles. This from 186 to 208 upper circuit, 10% upper circuit Z Limited hit in this candle and in this candle. And if you refer to this in 2021, let me go there, 2020, yeah, you see this green candle. This is that green candle from 205 to 260, 30% rise in one day. So this was the demand created, but he was not able to buy all the stocks at his desired price. Think of that. Someone wants to buy 2 crore shares at 210 rupees and price shot up to 260. Will he buy at 50 rupees more, 2 crore shares? It will be very costly for him. So he waited for so many months.
In this 2 crore shares, so whatever he was putting either 200, 210 or 205 or 230, how should we estimate?
That we cannot estimate. They have a range. Each and every big investors have a range. They calculate and they fix that, okay, I want 1 crore share from 200 to 205 rupees.
Okay.
Okay. So simple understanding is, if you see all these are daily candles. Okay. What is the range of the price? 220 to 215. These. Suppose how many days price was stuck here? Almost you can say 10 days. Now think yourself as a big investor. You want 1 crore shares between 215 to 220. Now price was 10 days stuck here. And now consider same scenario here. You want at the same range. but price went up within 15 minutes. So in which case you will get all of your orders. You will get here all your orders, because the more price stays at that point, the more you can buy, because at the same price seller will keep coming, they will keep selling the share, and you will keep buying slow and steady, and you will get all your 1 crore shares. But here, since price exploded, there was very few sellers here. There were buyers more. So all the orders could not be fulfilled here. So when we come to demand and supply theory, we will when we learn the structures, these observations will become very, very significant.
Okay.
Okay, we will come to that. So if you again draw an analogy, suppose I am a beggar. I am begging. I am begging from 9 a.m. to 3 p.m. And again, another day, I am begging only from 9 a.m. to 10 a.m. What is the chance that I would get more money, considering the fact that people are constant? Same people are coming, not more than that. There is more chance that I will earn more here because I am spending more time here in begging. There is more chance that I can get more money. Here, there is less chance that I can get more money in 1 hour. So more the time is spent on a price, more the orders get fulfilled one by one, and quicker the prices leave, the order gets pending there. We'll come to these things one by one. It is a very beautiful thing when you start understanding how this demand and supply theory works. It is very, very fundamental thing and very simple and easy to understand. Only point is that proper concentration is required. When someone teaches you, you should feel concentrated. And if any point, if you feel that you are not able to concentrate, you should honestly say that Akash, we are unable to concentrate today. Let's not go much further, because there is no point discussing that. We can then again do that later on also. So concentration is pretty much important. Okay.
Yeah. Thank you very much, Akash. I think everybody is interested. So most of them have stayed for 1 hour and 20 minutes.
Sure.
So
thank you
we
very
are
much.
very glad for that.
Okay. So if there is no more queries, then shall we wind up?
Anyone has any question? Or would like to speak anything regarding the sessions, how they are and any improvements needed? How are you feeling about the sessions? We would like to hear that. Yes, Yashwant. Can you try to unmute yourself? Yeah.
Yes, Karthik. That's really good sessions. I just want to appreciate your and Akash efforts for creating such kind of sessions. That's just want to appreciate that.
Thank you. Thank you very much.
Thank you. Thanks a lot, guys. So in the next session, we will go into, again, we will go back to candlesticks, but we'll learn something new. And slowly we will try to join all the jigsaw puzzles, whatever we are learning in bits and pieces, to create a whole picture one by one.
Okay. So one request at last. So suppose you ate good food in some stall. What do you do? Can anyone try to answer?
We will share the feedback to others.
Yeah, we will refer others, right? So if you are really liking the sessions, please let your friends and family know. Okay, add them to the WhatsApp group so that they will get to know about the future sessions. We have more in pipeline. See, the more participants we get, the more we can bring. So as of now, I'm thinking like we have to still groom the participants to join. So if more people are joining, it doesn't go waste, actually. Okay. So not only about this, but other sessions also. There was good feedback for personal finance session also. Other more too will come. So like that. Okay. Please like, subscribe, and share the YouTube channel as well. Thank you very much for joining. We'll meet in the next webinar, probably next week.
Yeah, sure, Karthik.
Thank you. Thank you, everybody. Thank you very much, Akash.
Thank you, guys. Thanks a lot. See you next week.